All right, good morning, everybody. We are going to get started here in just a minute. Let me know if you guys can hear me okay. Just quickly let us know in the little chat box there on your screen. And then we will be ready to rock. Yeah, just if you guys can hear me, just put a quick yes. There you go, perfect. Sounds like we're good. Good morning, everybody. Yes, we're going to get started here in just 1 second. Just want to quickly check the audio one more time. And then we'll be good. Perfect. Okay, cool. Listen, let's get started. It's right at the top of the hour. Actually, it's 1 minute past the top of the hour, at least according to my iPhone. I hope this format is working for you, and it was fun yesterday. Let me check one more thing here. Yeah, I think we should be good now. There you go. And so just to kind of clarify what we were saying yesterday, so this is essentially our morning show that we're going to start doing, or we started doing, I should say, yesterday, Monday through Thursday. We do it Monday through Thursday because I think typically Friday is there's not a whole lot to do or say typically. And if we have to do it on a Friday sometimes, then we, of course, will. But I think for the time being, we're going to keep it to, there's something flickering in here. Unbelievable. Anyway, so that's why we're doing it Monday through Thursday. At least that's the game plan for now. So, what I want to talk about today is J.P. Morgan, and obviously, this is an important name. It's an important name to me personally, as it's my alma mater. But I'll give you another reason why it's important, and that is the following. So, when we look at J.P. Morgan, we need to understand how closely correlated this stock is to the S&P 500. And so what I did here is I took two lines. I took the line that is, I guess, red or purple, and that's the S&P, the SPY, and I overlaid it with the price or the share price of J.P. Morgan, which is blue. And so what you can see is essentially a stock that is almost 100% exactly in terms of turn for turn tracking with the S&P 500. If we pull back the curtain here a little bit more and make this, let's say, a weekly chart, you would see something quite similar, just with more gyrations, but the same idea. So you can see that JP Morgan is the stock market, not that is the only stock, of course, but that is closely related. So then when we get a day like yesterday, and I want to get to this here in a second, because I think yesterday was an important day in terms of signaling where the equity market, the S&P, essentially completely diverged away from JP Morgan, or vice versa, really, I guess is probably the better way of putting it. I really have to sit up and take notice. And so what we had yesterday, if I zoom in a bit closer so you guys can all see this correlation, I always say if there's two stocks you want to watch in terms of the broader U.S. equity market you want to watch JP Morgan, and then you want to watch something a bit more consumer sort of cyclical, like maybe like a Caterpillar, or cyclical in terms of the economy, something like a Caterpillar. Those are typically good stocks to watch. But if you now look at this more closely and we zoom in, what you can see is that over the past few days, JP Morgan has been essentially making lower highs, and the S&P has once again found a bounce for 2 days. And so to me, that's important because I know how closely they're correlated, and I do think JP Morgan typically tells a truer story. Goldman Sachs is in there as well, not to make things too convoluted, but I do think Goldman Sachs is another way of looking at it. And again, there's really no mystery here. You can see that these three lines, for the most part, match up. It's J.P. Morgan and Goldman Sachs and the S&P. They are telling us basically the broader theme for the market. So now that we've got this kind of baseline mapped out, the question, of course, is what is there to do with JP Morgan? I've had, just so you guys know, I've had a conference call early this morning with my ex-colleagues in London that I used to work with together on the trading floor at JP Morgan with 3 out of 10 of them. I guess I must have been more than 10 in our team, but anyway, 3 of them. And we were going through specifically for the equity. We were looking at the credit markets more specifically in terms of what the bonds are telling us. There's not really a problem in the bond market yet for JP Morgan, but there's underlying credit problems that we want to be aware of elsewhere. So let's see how this translates into JP Morgan. Before we look at JP Morgan in isolation, let's have a look at Ally. And this is, of course, a stock that yesterday had one of its worst drops in history of it trading. It was down almost 18% on the day. Basically, I would call that it got re-rated. So it broke pretty much every trend there possibly is. And the reason they did that is because they basically said that their consumer, the clientele on the auto loan side is having basically more credit problems than they thought they would. And then this morning, and the last part of the narrative before we go into the actual chart, this morning then I was watching with one eye. I would like to watch CNBC with like one eye or a quarter of an eye, and I don't listen. I just watch. That's when you put on CNBC, it's not about listening. It's about watching it's like the headlines. But they had 2 bank analysts on, and one of them, both of them said the same thing. Essentially, just backward-looking, metrics or listening to what the CEO has to say. As someone who's traded through the great financial crisis, the GFC as we call it, back in 07 or 09, I was actually at JP Morgan at that time, trading the credit default swaps. And I can tell you what you don't want to, the last thing you want to do when things start to deteriorate is listen to the CEOs. Because the CEOs are always going to be rosy, unless they're a bank like Ally where they can't possibly hide it. But if the president of JP Morgan or any other of these big banks tells you everything is great, they're not going to tell you things suck until they really suck. Unless they're like, Jamie Dimon, he's got a different role. Let's put it that way. So long story short, where are we in all of this? Well, if we now look at this and just look at JP Morgan itself, to me, the chart itself isn't really all that revealing because we're still holding support. We're holding kind of easy, simple support levels that it could bounce from. But when I start going a bit deeper and I look at, for example, our momentum indicator, this is what we call the TST trender. And you can see we got a fresh buy signal on our momentum indicator on August the 14th, and then the stock took off by about 6 or 7%. I think we're about to see the momentum signal turn bearish. It hasn't happened yet, but I think just a little bit more downside here, and we are probably going to start to see this momentum trade actually go negative. To give you sort of a forward-looking idea on this, I went a step further and I started looking at what the algorithms are looking at. So we use this thing called Liquidity IQ that I use in conjunction with my friend Daniel Sinig. And there's really no support here for JP Morgan from an algo perspective until we get back to the August lows. Now you might say that's an obvious level, but it's not. It's only obvious in hindsight. It's where there's a lot of support. So the support range right now is somewhere between about 196, let's call it, and about 186. So it's about a $10 wide range. So from yesterday's close to get to the top of that range, it's down, let's call it 5%. To get to the bottom of that range, it's twice that, right? About 10%. So that's kind of what I'm looking for. So again, momentum has not yet changed, but it could change. Again, this is using our momentum work, using the TST trender. We got a buy signal. I do expect a sell signal here, but we do need a little bit more confirmation, another down day, or at least a little bit more time of another day or two for this to trigger. But once that does, I think we're looking at levels down here. So the aggressive trader here in me would probably just go and buy some put spreads. I wouldn't buy puts because the implied volatility has already gone up quite a bit. JP Morgan yesterday was down more than 5%, which is one of the bigger down days it's had in a long time. So I look at the implied volatility and I notice that implied volatility for JP Morgan is now back around 30, which is not cheap anymore. It's not expensive, but it's definitely no longer cheap. So if anything, I would do a bear put spread, again, down towards those levels I mentioned there. I do think, though, once we get to those levels down here, there might be a bounce or something, and we could put on some sort of an options credit spread. So that's kind of how I'm looking at this. And again, if you guys have questions here, please let me know. I know we're just getting started with our morning show, but we looked at general dynamics yesterday. Was an idea yesterday. I still think that's an interesting one. And here, JP Morgan this has a multifaceted angle, meaning we're looking at JP Morgan here through the lens of the macro lens, the credit cycle lens, the fact that it's a financial stock, the fact that it is the stock market, right? So I showed this chart here a few minutes ago. If you're just tuning in, welcome and good morning. But I showed this chart here that JP Morgan essentially is the S&P 500. It trades the same, but it's now diverging from the S&P. And I think ultimately S&P will probably have more downside as well in the near term. So that's what we're looking at here. And then there's one other point that I wanted to make here before we go on. Let me just check where that was. 1 second. Oh, I want to show you this chart here. This is my colleague and analyst, JB. He sent me this chart here, which is just kind of goes hand in hand with what I was just trying to show you with JP Morgan. Again, this is a bigger picture stuff. I know it's a touch small here potentially on the chart, but I'm hoping you can still see it. And what it is essentially showing us that all the sort of the risk on sectors, so high beta stocks have been selling off versus low volatility stocks, growth stocks have been underperforming value. Those are what we call factor exposures. Consumer discretionary has been underperforming consumer staples now basically all year. And we're starting to see a little bit of divergence in the S&P as well. So to me, this lines up from a seasonality perspective. I'm not a big seasonality person on its own, meaning seasonality on its own is a bull market analysis. It fails miserably in bear markets and neutral markets. It only works really well in raging bull markets with no volatility, but I think that's probably over. But we do have election year seasonality, and I think that is more important here. So that's why we think we're likely going to see some more volatility. Well, it's one of the reasons. And then ultimately, we do think we'll get a buyable dip, but we do have to wait more for that as far as I'm concerned, at least as of right now. So that is what I want to go through, short and sweet. 15 minutes, not even here this morning. If you guys have any questions, I'm happy to stick around another few minutes. But again, hopefully this gives you a little bit of color in terms of that meaningful down day yesterday in JP Morgan, and what that might mean going forward for the broader market as well. So if you want to give us a thumbs up if you liked it, thumbs down if you think this is crap. Let us know. Obviously, we're here to do this. We're doing this for you and making sure that you get the most out of this as possible. So every morning we convene here Monday through Thursday, and had a good start yesterday. A lot of great feedback. We're going to continue doing this here today with the idea in JP Morgan. So hopefully this is giving you some insight, not just narratives. I think the whole point of the reason I want to do this is because I don't want to do narratives. I want to do analysis that is not biased because in the markets, one of the worst things we can do is become biased. Biased in terms of certain views. That can be political views or some other bias. It just doesn't, it really keeps us from making money, right? So, so that's where we are. Hope it was helpful, folks. We'll see you back here tomorrow. And if you are a Vertical X Pro member, we'll see you guys tomorrow in our members webinar. There's a new trade setting up as well. So thanks for joining, folks. We'll see you tomorrow.